I'm the president of the Apartment Owners Association of California. It's great to have you with us today. We have a great event. 2 speakers will be awesome. And did you miss it last week? Carla Dennis, she talked about Biden. What does Joe Biden's tax plan look like for you and your money? It was great. Lots of insider information on what's being planned. And we'll see what the final result becomes. But that was a great one. You'll want to go back and look at that. And we got one next week. The week after that is how to be ADA compliant. And then we'll have Dennis Block the week after that for Southern California legal update. And then we'll have a Northern California legal update later on in August, the week after that. So lots of good stuff. If this is the type of information, the type of content that you like to listen to, that you want to listen to, I want to encourage you to subscribe to this YouTube channel. And then also, I want, there's a free e-newsletter that you can sign up for on the AOA website. That's aoausa.com. Bottom right side, there is a place where you can sign up. And also, before we get started, I just want you to know, listen to everything, and then at the end, ask questions. And there's a blue help button. If you're on the aoausa.com website, you can put your questions in there. If you're on YouTube, Facebook, welcome. You just put your questions into the chat. Everything will make its way to me, and I'll be able to ask questions from our speakers today. And so that's the housekeeping. Again, it's great to have you with us. Our sponsor today is H&S Wealth. They are experts in 1031 exchanges, and we've had a relationship with them. They've been working with AOA members for for about 20 years now, and so they do great work, and they come highly recommended from different people, and so it's really a pleasure to have them come on. And our first speaker today started as a transaction coordinator back in 2010, so she's really good with the details, and she's put together deals from 100-unit buildings down to single-family homes, and she is a realtor, and she works with AOA Brokerage, and so I just want to introduce to you today Sarah Ianni.
Hello, everybody. Thank you very much, Jeff, for that introduction. I really appreciate it. It's an honor to be here. As you mentioned, my name is Sarah Ianni, and I am a real estate agent. I am with AOA Commercial Brokerage, and AOA Commercial Brokerage has been servicing apartment owners for the past 40 years. We do specialize in the sale of apartment buildings as a full-service real estate brokerage. So if for any reason you need to get a hold of a brokerage firm that you can trust, go ahead and just call AOA, ask for Sarah and Brokerage, and they'll transfer you right over. Also, our contact information is right there displayed on the lower screen, so I would suggest to just go ahead and jot that down in your notes. Keep it handy. Anytime you have a real estate question, call AOA, ask for the brokerage department, and we're there to help. Now, first, I just wanted to repeat, in case anybody logged on late, please feel free to engage in this webinar with your questions. There are chat box. Utilize those. That's really one of the benefits from watching this live. Yes, it's going to be on YouTube and it'll be up forever and ever. But right now that you have the speakers, go ahead and utilize that chat box and take advantage of asking questions. So if you're on Facebook or YouTube, that's just the comment box. If you are watching this directly from the live stream on the website, there's that little blue oval shaped help button. Click that, and then I think you're going to click like ask questions or whatnot, and then that'll get the questions over to Jeff, and then we'll be able to hopefully answer anything that you have to ask after hearing the presentation. Now, we all know that this is an unusual time in real estate. You don't need me to tell you that this is still a seller's market. It's still a hot market. You don't need me to tell you that. In fact, if you currently own properties, I'm sure you're getting offers from investors or buyers, and those might not, and that maybe that's how you're indicating what your property is worth. However, if you're getting an offer, that might not be the true current value. You know, if you're going to give an offer to somebody, you're not going to automatically just give your highest offer. You're going to maybe start low. So for that reason, AOA Commercial Brokerage is here, and we are on the apartment owner's side. Always have been, always will be. So go ahead and call us. Let us evaluate your building. Let us look at the numbers and tell you the true current value. Okay, so whether you're planning to utilize a 1031 tax exchange, whether you're planning to just cash out and go ahead and pay the taxes, whether you are maybe contemplating a different avenue, you don't really want to be involved with all the day-to-day activities. You're maybe at a point of your housing providing career where this might be a time where you still want to generate your income and maybe even generate more income, but yet you do know that when you sell your building, you're going to face a tax bite, and that's something that's stopping you. So go ahead and just call us and let us, we'll just analyze your property and we'll go from there. So to properly determine the value of your asset, at this point of the real estate cycle, I would say that there are so many different variables, and each building has its own unique value. And to properly determine those values, we can't just quickly look at a website. We can't just quickly look at comps, because we don't know the specifics of those buildings. We don't know what the rents are. We don't know the condition of the building. We do need some information. And for that, it would be essential to just have a little conversation with you prior to getting you a value. So that's why we just say, write down our phone number, write down our email if this is something that you're contemplating. And then if the numbers do make sense and it is the right time for you, then we can definitely move forward with helping you move your building to the next phase of your life. As you may have heard here many times before at AOA, as housing providers, our main goal is that you will find at least one idea that will help you make and or keep more money than ever before. And if you are, like I mentioned before, if you are contemplating the sale of your building and you are aware that there's going to be an enormous tax bite, that is bad news. But the good news is that the capital gains taxes can be deferred and maybe even ultimately avoided with the right strategies, the right information, the right plans in place. And that is what we plan to share with you here today. Adam Bryan is with H&S Wealth Management. They are financial advisors. He has been in the 1031 tax exchange industry for over 20 years and now working more specifically with Delaware statutory trusts, also known as DSTs. AOA has been working with Adam, or H&S Wealth Management more specifically, for at least 20 years. So, we highly suggest that you go ahead and take a listen to what he has to say, and he knows his stuff. That's basically it for me. Thank you very much for listening and just hearing what I had to say. Like I mentioned before, any questions regarding real estate, go ahead and call AOA, ask for the brokerage department, ask for Sarah. They'll transfer you right over and hear what he has to say. He's going to have some great information.
Thank you, Sarah. I appreciate that introduction. And I thought today what we'd talk about, it seems to be on everyone's mind, and that is, are we in a real estate bubble? Now, the answer to that question is maybe. Maybe we are and maybe we're not. What I like to emphasize when I educate and do speaking engagements and talk to individual clients and investors is that, there really are no solid answers any person can give you. Nobody really has that crystal ball. It would be great if they did. But the reality is, when you hear people like me, educators, pundits on the news and financial news, giving you opinions about where the financial markets will be, where the real estate market will be, I'm not saying disregard them. I'm saying keep in mind that these are ultimately guesses. Now, there's a difference between a wild guess and an educated guess. And what you should be focusing on are the educated guesses. What are people talking about based on the facts as they exist, as opposed to just a wild projection? So while I'll tell you where we're at today, and maybe we can form some conclusions, we all have our own opinions, and certainly I have mine. What I like to focus on are the specific details and facts, because those aren't movable. Those don't change. They simply are what they are. What they predict is a question mark, and I'll give you my thoughts on that by the time we wrap up from this portion of my talk. So first of all, are we in a bubble? The thing to consider is, first of all, what is the definition of a bubble, or specifically a real estate bubble? How do you define it? Even though we all hear that term, you may have used it in your own conversations, the truth is there is no real definition when it comes to the real estate market of what a bubble is. So I thought I would look it up on Merriam-Webster dictionary, if I can unlock my phone. And I can tell you a bubble is used to refer to a good or fortunate situation that is isolated from reality and or unlikely to last. That's one of the definitions of a bubble. And that sounds about right. Unconnected to reality, I think that's an important thing. There's another definition. It's a thin sphere of liquid enclosing air or another gas. And why do I mention that? Well, I like to think of a bubble as the second definition. Is there air inside of a bubble? Is there something solid inside of a bubble? And what do I mean by that? Well, let's go back to the last bubble that we all know about, 2007, and prior to the crash that we saw, or the popping of that bubble. What was the air and what was the solid? Well, I would argue that in this analogy, homes and multifamily units and other commercial properties that are being purchased to generate income or to live in, if it's a residence, it would be something solid. That would not be air. That would not be real. And the prices paid for those properties would also be something real and something solid. So what was the air that was happening? As we all recall, home prices, not only did they rise unrealistically dramatically high, but they were financed at unrealistically dramatically high leverage levels. Most of it was not the investor or the homeowner's money, it was sort of the bank's money. But of course, we all know the banks sold those loans off to Wall Street and levered them up. So there wasn't anything real there. And when I say real in this example, I mean equity. People that were buying homes, let's say 2004 through 7, number one, they were often selling them very quickly. Either they were doing it speculatively as an investment or a flip. We all remember that was happening quite a bit, and people were making pretty big profits. Or even homeowners that would buy a home 6 months later, it had gone up 20-30%, and they said, why don't I move again? So they weren't staying put and using it as their true residence that they're planning on staying in. Even those who did stay, and this is extremely important going back to the Great Recession, they were using their homes as an ATM, as a cash machine. And what do I mean by that? Well, they're in this home, they're going to live there. They don't have a lot of equity, meaning a down payment. A lot of it's the bank's money. But then, because the value of the home appeared to have appreciated so much, they decided, let's remodel the kitchen. Let's get that new car. And that's good for the economy because they were spending money. But where did they get that money? Well, they had a second trust deed. They were pulling equity or value, what little there was, out of the home and using it to spend money. Well, the spending part was good for the economy, but ultimately, if there's nothing inside, meaning equity and value, the bubble bursts. And that's probably an oversimplification, but that's what we saw happen in 2007. There was no real value there. There wasn't a lot of equity there. There weren't a lot of investors buying, putting a reasonable amount of equity and holding for the long term. There were a lot of flipping and pulling equity out to spend it on other things. They weren't using that home or that apartment building to own it, to manage it, to receive income, to live in it for the long term. It became something else. And whatever that something else is, to me, it was air. It was the air inside of that liquid enclosure, and that's why it burst. So are we there now? We certainly have some similarities to 2005, 6, 7. Prices are extremely high. The number of offers people are receiving are incredible. Sarah runs across this all the time. The number of buyers that are all cash, they're saying there's no loan contingency, or even sometimes there's no due diligence contingency inspection, which is crazy. That certainly feels like 2007, doesn't it? But there are some differences I want to talk about. There was a study done by a group called Rosen Consulting Group, and what Rosen found was, depending on how you slice the numbers, somewhere between 5 and 6.8 million housing units are needed at this point. And the way they defined it are single-family homes, apartment units, condominiums, anything that people are living in, whether they own it and rent it out or they live in it themselves. Right now, we're somewhere, again, between that 5 to 6.8 at the most, probably, million units that could be accommodated, that there are people that could utilize or want to utilize and are just not able to. They're missing the inventory. There's not enough listings. There's not enough properties out there. Well, what is the solution to that? Number one, the existing homeowners and apartment owners list their properties, and that creates more inventory. But that's not happening a lot for many reasons right now. And the second reason is the construction. Normally, not so much in Southern California, a little bit more in Northern California, but certainly in other parts of the country, new construction is a big driver of housing. And right now, we're seeing a tiny percentage, only about 1.5 million homes a year are being constructed, or housing units. That's versus the up to 6.8 million that are needed, but only 1.5 a year are being created. So there's a dearth of product, as we say, of units, of places for people to live and move into and buy and rent out. There's a disconnect there. Part of the reason is the disruption in the supply chains. We've all kind of noticed that used cars have gone up 20 to 30%. Lumber has tripled, lumber being key, of course, to construction. Supply chains of being interrupted means it's more expensive to have workers to order the supplies to build the home, and so forth. So as a result, we don't have nearly enough product or inventory or homes and apartment buildings for the buyers that are out there. Whenever you have a disparity between what we all remember from high school, supply and demand, that means that we're going to end up having price appreciation, because a lot of people want to own a very few products that are out there, homes, apartment buildings. So what happens to the price of those few that are available? Well, of course, they rise. That's what we've been seeing in recent 12 to 18 months, I would say, going back. Inventories, as far as the number of available properties, whether you're, and this is a general nationwide number, whether you're an apartment buyer or just looking for a home or a condo, we're about 38% down, 38%. So think of it in another way, where if you had 10 properties that you were competing with other buyers in a normal market, now you have 3 or 4. Again, not enough out there, which is creating this price appreciation. Is it artificial? Is it fake? Is it air? Well, that's what we're talking about today. But it's an interesting thing. You know, when there are new units constructed, whether it's an apartment building, again, or homes, a big chunk of this need, of this 5.8 million demand, are really lower and middle income folks that are looking for long-term residency or apartment buildings. But if you're a builder and developer, especially in this market, but even in general, you know, you want to build the highest end apartment building or home because you get the best return on your investment. So there aren't enough lower income or middle income housing units being created. And that again is exacerbating the problem, because the few that are being built, the 1.5 million roughly, I don't know the exact percentage, but a substantial number are on the higher end of the income spectrum for those buyers, or the quality of those properties. They're more expensive. And that's just contributing to this. Also, as we're all too familiar with in Southern California, there are great inhibitors to building and developing property. You need to go through permitting and getting what they call entitlements from the city and the local area. Well, that sort of apprehension about too much density or building, even though they're fighting it and trying to do things like the ADUs rather, and all of those efforts, around the country, we're seeing more of that. It's harder to build. It's harder to get the entitlements. It's harder to make sure that the sewer and electric is in for those expanding neighborhoods. All of this is contributing to, again, less new inventory, less affordable inventory. But as I always say, we're a great country, and one of the great things about us is we make a lot of babies. Every day we have new taxpayers, we have new consumers that are born, we have new home buyers. And that growth, that inflation, if you will, in population, it needs to be accommodated when it comes to housing units, and it's just not happening right now. And that's part of the big problem we're having, if you will, where we're seeing this tremendous price appreciation. Let's talk a little bit about debt. An important element of all of this conversation is debt or loans or financing. Most people don't go buy their home or their multifamily rental or their commercial property even with all cash. Certainly we're seeing more of that, and it makes it a very appealing offer, But we rely as an economy very much on financing and debt. The entire federal government, as we know, is in the hole, something like $23 trillion, I believe, right now. That's just the way our economy functions, through financing and debt. Well, as we all know, interest rates have been kept low, arguably artificially low, for many years, since the Great Recession, in fact. Just last year alone, we hit 15 historic lows on interest rates, 15 times. So we are seeing some of the lowest interest rates, I believe, in history, certainly in a generation or two. Well, what does that mean? That means that buyers, of course, are able to buy property and get very attractive interest rates, which would incentivize, as you can imagine, many people to buy right now or to refinance. And again, that's creating more of that demand that I talked about earlier that doesn't have the supply to accommodate it. It's only encouraging this problem, if you will. Again, driving up prices. Now, the higher prices get, you may say, well, if you can get a really low interest rate, and let's say you're a first-time buyer, there are still those 3% down first-time buyer programs that are available through the federal government. Well, the problem is the prices are so high that if they've only put a relatively low amount of equity down payment into the property, the monthly mortgage payment is too high. They still own so much money that they can't afford that mortgage payment, even though they're able to get in with a low down payment. And that's creating a problem, again, for those lower income generally or first-time buyers. So we're in an unusual situation. We've talked and heard a lot about inflation, especially since COVID has sort of turned the corner. What I remind people is when you hear numbers on the news about inflation, about the prices rising, keep in mind a couple of things. It's a comparison to where we were a year ago, number one, and it's an annualized number. And by that I mean they'll take a current quarter's inflation price growth and then multiply it by 4. So they're annualizing it. They're assuming it's going to happen this way each quarter moving forward. And they're comparing it to, in this case, July of 2020. I don't want to remind you of July of 2020 because it was incredibly boring and very little was happening. Most of us were home watching Netflix. But when we look at the prices and where they were July of 2020 and where they are in July of 2021, yes, they're dramatically higher. A lot of things have changed. And again, those supply lines that affect construction and lumber costs, that affects everything, again, from used cars to bread and butter at the supermarket. So we're seeing, and my point being, this inflation, but it's exaggerated in my opinion. In fact, and in actuality, the appreciation in prices that we are seeing for goods and services, it's kind of artificial. It's temporary. Now, many people say, hey, Adam, maybe those prices will stay high. And you know what? Maybe they will. I don't have a crystal ball. But I do know that if you're looking at a very unusual time in our economy and our country, July 2020, and comparing prices today, when it's been very difficult to get things back on the shelves, you're going to see some, pretty dramatic price rises. And in fact, if you multiply it by 4 and annualize the number, you're going to see something like 7% inflation. Ideally, we want to be around 2. But we're not at 7% inflation. That hasn't happened. Will it happen? Again, I can't tell you for sure, but factually speaking, you're really just looking at a reaction to those 6-8 months where things were very unusual and slow. Now we're kind of getting back to normal, but you can't just flick a switch and suddenly have enough cars on the lot or homes to buy. It doesn't happen overnight. So, in my view, inflation, we don't know where it'll be, but it probably won't be as dramatically high as it's been in recent quarters, and I think we'll start to see it normalize. And the reason I mention all of this in connection to debt is the Federal Reserve that sets the overnight rate, which ultimately dictates what our interest rates are on our mortgages or our car payments, is impacted by inflation. It'll rise with inflation. So there is a lot of fear, and you saw on Tuesday the stock market overreact, one could argue, for fear that there would suddenly be the Fed raising interest rates to accommodate this inflation that I call temporary that we're seeing. Wednesday, it very quickly reversed and replaced all those losses and grew. So bottom line, the Fed has been very consistent in what their statements are. They want to manage the economy with the tools they have, one of which is through interest rates. They want to manage and get the most effective employment numbers, avoiding unemployment, and doing what they can to influence it, mostly through bond buying and ultimately controlling interest rate. Most people call that printing money, which isn't exactly right, but it gives you an idea of what's happening. We're just creating more money in the economy when the Fed buys federal bonds. So what they have been saying, and what I believe they will continue to do, is to just track where inflation's at and watch it. And they too have acknowledged that they feel this is somewhat temporary, although we, again, don't know what's going to happen next year. But when and if we hit inflation, that means interest rates will rise. When interest rates rise, that will remove some of these buyers, some of this demand in the market for these few properties that are available, which arguably would stabilize prices, maybe even bring them down. But will they pop? Will the bubble pop? Well, that's kind of the question. All I can tell you is that they make these decisions quarterly. They make their notes available after their meetings afterwards so that we can know their thinking, but we don't have it in real time. Everything seems consistent that there will not be any dramatic rises in the interest rates. We're still around 0 to 0.25% overnight rate. That's the rate that the banks lend each other. And frankly, I've been in this industry since 2002, but since 2009, there's been this fear of inflation running rampant and interest rates rising. It hasn't happened. Doesn't mean it won't. It's maybe dangerous that it's been going on for so long now, well over 10 years. But the reality is, as long as we keep making what's called debt service, make the bond payments, this can go on for quite a long time. If rates remain where they're at or only slightly rise, as we've seen in recent months, we went from sub 3% on a 30-year loan, 2.8, 2.9. Now I'm seeing 3.25, 3.10 or 1.5. Maybe again we'll see some slight increase, but not dramatic, and certainly not, let's say, double. If all of a sudden tomorrow interest rates were 6% on a 30-year mortgage, yes, you would see a dramatic increase. Could it mean a bubble bursting and prices dropping dramatically? Possibly. I'm not going to tell you that wouldn't happen. But what I will tell you is that it would be unprecedented, virtually impossible, although nothing's impossible, that the Fed would double interest rates in one quarter. That just doesn't happen. And again, it only happens quarterly. So what I'm saying is these things are more gradual. It isn't really that you're blindsided. You actually do have a lot of advance notice. Even in 2008, really, when the real estate bubble burst, I think most of us knew it was crazy, just like we kind of feel like it is right now. But the factors and the reasons behind it was crazy then just don't exist today. Let me talk about that because that's important. Equity. Equity means the value that you have in a property that you don't owe the bank. Equity is very real right now. First of all, there are many cash buyers. There's a lot of cash out there. Companies, in fact, are holding record numbers of liquid cash on their books. And homeowners, people who weren't spending during the pandemic, their savings account and checking accounts are, again, record levels. So there is a lot of real equity, real cash in the market, and it is going into real estate. Number one, certainly there are all cash buyers. That's not common, but it happens, and they're often the winning bidder since there's no loan contingency. And number two, the down payments that are required are really far more conservative than they were in 2007. Again, in those days, it was somewhat ridiculous, the amount of debt that you were able to get. You could buy a house with 0 down, even if you weren't a first-time home buyer. Well, those programs don't exist anymore. The federal government for a non-first-time buyer is still looking at Fannie and Freddie, who back these loans, looking at 20% down. Investment property, many of you own apartments or units or rental homes, are looking for maybe 30% down, 25% down. Real equity, again, is going into the purchases that are occurring and that have been occurring really since the Great Recession. This is not new. I like to say banks got religion, got very conservative after the Great Recession and realized the error of their ways. If anything, maybe they've been over-regulated, overly cautious, but if anything, it's creating far more stable real estate valuations with, again, real equity behind it, not just a loan or a piece of paper, but cash that was used to purchase the property. Well, that's what we're seeing now. Another good statistic for you, again, nationwide number, So real estate's local and everything's a little bit different, but as a general rule, I would say this applies to Southern California too. Right now, if you looked at how many people are underwater in their property, underwater meaning that the loan that they owe is actually higher than the value of the property, it's about 2.8%. And that's considered low historically. It's not a dramatically high number. It's not unusual. So 2.8% of people, actually, they may be, in fact, are often making their payments. We're seeing lows on foreclosures and short sales and so forth. 2.8%, 2021. Anybody want to guess? I'm used to having an audience to give me feedback. Does anybody want to guess what it was in late 2009 after the bottom had fallen out? And the answer is it was at 26% of homes were underwater nationwide, much higher in the Inland Empire, Las Vegas, parts of Arizona. But again, as an average, 26%, 1 in 4 people owed more to the bank than the value of their home. That's a significant difference from where we are today, with most homes being above or maybe even substantially above the loan that's owed on the property. So again, there's something real in these properties. There's equity, there's cash, there's people that are living there and electing to stay there and make it their home for, you know, the average 8-year period or what have you. In other words, they're not just flipping necessarily, not commonly enough. And all of these factors are driving up the value of the real estate. But it brings us back to the question of, are we in a bubble? Is it going to stop? Is it going to end? And again, I'll tell you, I don't know. But what I can tell you is when you look at the conditions that we had in the last real estate bubble, and we look at the conditions that we have now, they are extremely different. And as I mentioned with the Fed and interest rates, these things don't change overnight. Suddenly we're not going to see very few record low listings on the market, and then suddenly Sarah's got 5 times as many. It just doesn't happen overnight. It can happen certainly, but not very quickly. There's going to be a time lag. What is that time lag? It's hard to give a real number, but I'm confident enough to say, you know, the next 6 months to 12 months, even a year, next July, I don't see things changing too dramatically. Obviously, the further out we get, the less my educated guess, hopefully, is. But in the near term, I feel like we're okay. I don't see any bubble bursting overnight. Probably not next quarter, probably not by the holidays, and that's how I end up getting to that 6 to 12 month period. Adam, what happens after that, you may ask? I don't know. I didn't expect to see the pandemic, which of course had a dramatic impact on our economy. On the other hand, real estate values rose 8 to 10% that last year nationwide for single family homes. So again, there's so much you really can't know. And that leads me to my next point. That's where I feel we're at now in the real estate markets. But what do I do as a rental investor or multifamily owner or rental homes? Should I sell? Certainly, if you feel like you're in a bubble, now would be the time to sell at the top of the market. And I'm not going to tell you that's wrong necessary or right. Again, I have to say maybe or maybe not. It's a very personal decision. It's an individual decision. You can't make a rule that's right for everybody. Maybe you want to continue to own your property and it may drop in the future. Maybe you're okay for 6 to 12 months, as I suggested, and come what may in a year or two. But you're getting your rent, your tenants have been good to you, property value has steadily increased since you've owned it. Maybe you shouldn't be selling now. I'm not here to tell you that. And conversely, you know, maybe you bought it a few years ago. It's done incredibly well in the last few years, and you'd like to take some of that equity, that capital off the table and not leave that cash, if you will, invested in the property, which could, remember, lose value. Probably not next week, but eventually. So that may be a motivation for you to sell now and do an exchange, a 1031 exchange. Well, I can't tell you which one you should do. It's a conversation we can have. What I can tell you is where market trends are at, where we are. You've already heard some good numbers from Sarah. We know that there's very little product. We know that prices have been appreciating, but we also know affordability is really getting stretched beyond, you know, I won't say beyond belief, but incredibly. A study was done comparing a 17-year period, 2000 to 2017, and they looked at the average rents in Los Angeles County adjusted the numbers for inflation. So whenever you look back at time, you have to remember that a dollar bought a different amount of product or service than it does today. But adjusted for inflation, everything being equal, the numbers of 2000 versus 2017, the rents for a comparable unit, for the same unit, rose about 32%. That means that whatever you were earning in the year 2000, you're paying 30% more for that same unit that you're renting in the year 2017. Roughly, we had a little bit of wage increase. We're seeing a little bit of that now, but roughly we're about at very, very close to 30%. When we look at the income, the average income in the county of Los Angeles in the year 2000 versus 2017, and vaguely adjusting for the last 3-4 years, how much did wages go up? In other words, if the rent went up, then one would think that people would be earning more money. Well, in Los Angeles County, the answer used to be minus 2% in the year 2017. I believe now it's about flat. People are earning effectively the same amount of money or even a little bit less in recent years than they did in the year 2000. But again, their rent is up over 30%. They're paying more of their take-home pay to cover the rent, to cover the expenses of living in Southern California. It's just the nature of our market here. Even with the people that are moving out, even with the businesses that are moving out, people are still coming, and there is still demand, and people want to live here for all the positive reasons. So what that means is that if you value a real estate asset based on the income it can produce, and the income is produced from rent, whether it's commercial tenants or multifamily apartments or what have you, well, you can only charge so much rent. The valuation is determined by that income amount. And we're at pretty much top levels. Those of you who have been keeping up your rates with the market rates for rentals, you're getting top dollar. And when you valuate your property, you're getting top dollar. If, however, you can't continue to raise those rates, those rental rates, then your valuation can't continue to rise. It's simply a factor of that. And again, if we're already spending 30% more on average in Los Angeles County, then we're not able to increase the values a lot more. So what does that mean? Arguably, we're bumping up against the top of the market. We just can't be valued too much higher. It's exacerbated by the lack of product, but as a general rule, when you're getting top market rates, rental rates and income, you're getting top prices for the real estate. So I do believe right now we are at a peak. Doesn't mean that the bubble's going to burst and it'll drop dramatically overnight, as I've talked about, but we are kind of, I would say, almost reaching the point where if prices continued to rise at the pace they have been, there would be no buyers. It would just be unaffordable. And then we go back to prices coming down, but gradually. So we're at the top of the market, near the top of the market, in my opinion. Most people feel like, okay, it's a good time for me to sell. It does feel like we're at the top of the market. I know there's a tremendous amount of demand. What can I do? You can sell your property and pay your tax. The tax rates vary depending on your income, but not uncommonly, especially for Southern California, you're looking at 23.8% of your capital gain to the federal government. That's 20% cap gain, 3.8% Medicare tax. You're looking at up to 13.3% to the state of California. And you're looking at 25% recapture of depreciation you've claimed over the life of the property you sold. For most people, it's a general rule, but over a third of the money they pull out of their sale, if they made $1 million, their profit, could have been anywhere from around $1 million to $500,000. Most people end up losing about a third, about $330,000-$40,000 out of that million that goes to taxes, never to be seen again, never to earn another dollar for you, and leaving you with 2/3, 660 in my example. But that may be an option for some people, especially if you need liquid assets, cash. I'm not here to tell you don't do that, but as a general rule, if you have a safety net, if you have other sources of income that are reliable, it makes financial sense almost always to do a 1031 exchange because A, you're going to avoid losing a third of your money right off the top. B, even if you did do that, you need to do something with the remaining balance. You need to invest it. You could put it in the bank, but of course that's like putting it in the mattress right now. You'll be lucky to get 1% return on your money, not even keeping up with inflation. So for most people from a financial perspective, yes, you want to do a 1031 exchange, but you always have the option to pay the tax, take the money off the table, Or you could do a partial exchange. Many people aren't familiar with that concept, and that is to say it isn't an all or nothing proposition. If you have $1 million gain, you could take 200,000 out, take 800,000, reinvest it, and just pay tax on the 200,000. That's absolutely acceptable. If you are doing an exchange, the IRS has been doing this for 100 years. Bottom line, they changed the rules in the 80s. Once you sell that date of sale of your property, you have 45 days to identify what you intend to purchase, and you have up to 180 days to close on one of those nominations or identifications. That's the basic 1031 rule. Most people are faced with, well, I just sold in the San Fernando Valley. I got top dollar for my multifamily unit. That's great. But what am I going to buy? If I buy here, I'm going to be in this very expensive market. And I certainly understand that. That's true. You could buy out of state, but many people, they don't want to own the real estate solely and not be able to see it and touch it and talk to the property manager. So for those reasons, most people either make the decision between the two because they aren't aware of a third option. And the third option is called a Delaware Statutory Trust, or a DST, that you heard Sarah allude to later. These are some real-life examples of DST properties. They are what I call institutional, call it $40 to $100 million in value. They are properties that are generally located out of the major markets that are very expensive, Southern California, New York, Seattle, San Francisco, but they're in strong secondary markets, Orlando, Atlanta, Austin, Texas, Raleigh, Durham, North Carolina, Nashville, Tennessee. So they're in good growth markets where you're able to own a fractional interest in a Delaware statutory trust. In other words, you're not the sole owner of the property, you own your share of the property. So how does it work and what is it? First of all, it's been around since 2004. The IRS issued a revenue ruling, which essentially said anybody investing in a DST, it's the same as investing in your own sole-owned real estate, your own 1031 exchange. There's a sponsor company, not my firm, we're advisors, financial advisors that help you find the right property, but there are real estate companies, management investment companies, we use the word sponsor. They scour the country, they try to find quality investments, they acquire the properties. If they're using leverage, it's very conservative, 50 to 60% loan to value, and they're arranging for that financing in the name of a newly created entity. In other words, each acquisition is separate from the others. This is not a REIT or a pool. They're buying this property in Orlando, they put down half the cash, they arrange financing for the other half, and they can buy all kinds of real estate. My firm, our practice, we like to focus on multifamily and self-storage. It's simply held up the best through the difficult times we've seen over the last 20, 30 years. Banks love this arrangement. That's why they've gained popularity since the Great Recession, because there's only a single borrower. It is the entity itself. The sponsor acts as the guarantor and signator for the loan of the trust, because the trust is technically the borrower. Once they've wrapped it up, they own it, they're operating it. Now they're simply selling little pieces off to individual 1031 exchangers typically. Each owner is able to own really their own share of the property. I often say it's easier to think of it in terms of you and I going 50-50, splitting the down payment, splitting the cash flow and the expenses that we write off on our tax returns, and splitting the profit 50-50 when we sell. If you think of it like that, it's very simple. But when you can have up to 499 investors, it's a little more complicated, but effectively it's the exact same thing. Meaning instead of 50% of whatever, you're getting your 1% or whatever your percentage ownership is, which is based on how much you invest. Everything must flow through to the investors in a DST. That's why it's not an LLC or a limited partnership or any other entity or a REIT that you may be familiar with. It's very unique. They are only sold as securities. That's why financial advisors and not real estate agents sell them. You have to be an accredited investor, which is simply $1 million net worth exclusive of your residence. And they're not promoted widely. You don't see advertisements for them because the marketing is very limited since it is a regulated security. The sponsor sells off what are technically called beneficial membership interests in the DST. So again, not a deeded interest exactly. You're not on the loan directly. The lender doesn't even know who you are, but you own a little piece of an entity that owns real estate and has a loan, and all of that flows through to you. Any cash flow, any appreciation upon sale in the future, which is probably going to be 7 or 8 or 9 years down the line from today, all of that flows through 100% to each owner based on their contribution. The cash flow yields vary. It depends on the real estate, but let's call it 4.5 to 6% net cash on cash. After all the expenses of the property are paid, you would receive on $1 million, $45,000 to $60,000 a year, and it is distributed monthly. So the checks or the direct deposits occur monthly. The minimum investment is very low in a DST. As I mentioned, you can have up to 499 people investing, which means each individual investor can have a relatively small amount. Let's call it $100,000 in equity. Somebody coming out of an exchange with $300,000 or $400,000 they need to reinvest could technically buy 2 or 3 or even 4 different properties in different states, maybe different asset classes and different sponsors. It's all about diversifying your risk if it makes sense. You can exit early. There's no assurance that there'll be a buyer there. You have to think of it like a real estate asset, but you have the right to sell it, and if you find a buyer and you agree on a price, it's a fairly easy transaction. But don't think of these as a parking vehicle or something you can bop in and out of. They're really longer term investments. And lastly, think about the sponsor firm. What's the experience? We'll help you get educated on who these folks are, what their track record is. We'd like folks that have full cycle experience, have put together an offering, operated it, sold it, and I can show you specifically what the returns were for those past investors. Also, it's real estate. You know, location matters. The age of the property matters. And these are things we work with you on to make sure that we're reinvesting in the best options for you. Also in markets where there's positive job growth and population growth, that's really where you want to be, as opposed to markets that have negative growth. So you've got the chat box there that you heard Jeff talk about earlier, and I'm happy to answer some questions you might have. I know we've covered quite a bit of information, but if you put up on the screen there, you can see our team, and you can reach me directly. I think we've put up a couple of phone numbers on the banner there. There's our 800 for the office. My partner, Bob Horning, who you see and you may have seen in other advertisements, as well as Naomi and Riley that help us with client management. Reach out to us if you have a question. We know that you may not necessarily want to invest in a DST tomorrow. We realize it doesn't work that way. We want to help you make what's the best decision for you, and if you reinvest in a DST, to do so in the best options we have. And with that, I've overrun my time a little, Jeff, but I'll pass it back over.
Thank you, everybody. Before we get to questions, I think all of us have heard it said that a picture's worth 1,000 words. And this is a picture that's in the AOA USA magazine. It's also on the website. And this picture has been working. We actually did get a reply from one of the mayors. And so that was really interesting. But so thank you for those of you that have already filled this out and sent it in, and you're like, Jeff, what are you talking about? And so, yes, let me explain. We are having one of the largest demonstrations ever for apartment owners against the city, against the governor, against this moratorium. And they say that it's going to end at the end of September, but will it really? What will really happen? It's been extended multiple times already, and we've been lulled into this false sense that things will end, and we're passively sitting back thinking, oh, it will end, it will end, it will end. Unfortunately, it hasn't ended, and if you listen to what the tenant rights groups are saying, they would like to see it extended and extended and extended all the way through the end of the year. You hear city council members also talking about that. You see legislation in other states where they've already done that. They've already extended it to the end of the year. So I would like us to wake up. I would like your participation. We need it. You may not have a property that has a tenant who's not paying, but the industry needs it. The more regulation we have, the more that artificially they do this, it's bad for everyone. Think of tenants. The longer that they wait and accumulate a debt, that's only bad for them. It's bad for tenants. It's bad for all of us. You've heard the stories. We hear them very frequently, and it stinks. And so this needs to end. And the only way we can do that is to send them that picture something, one little letter won't do it, but when you send them a picture with something that you've written, it will make a difference. And we've already seen some. And so basically, we need to all get involved. If all of the members got involved, if we got 20,000 or 100,000 letters written to the governor, to the mayor of your specific city, to your city council members, then I believe that it really will end at the end of September. But if we are passive, if we don't act, we're going to be in trouble again and again and again. So please take action. You can download this at AOAUSA.com /protest. That's where you can download it. If you get the magazine, you can just tear it out of the magazine. So there's a letter there, there's this there. So send that to the governor, send it to your mayor, send it to your city council members. Show them paper. It's easy to ignore an email. It's a lot harder to ignore the paper. So there you have the information for you. So get involved. You can give. You can act. We're a grassroots movement. We're not spending a lot of money on salaries. There's nothing being spent like that. We're focusing our money mainly on lawsuits, and we're relying on all of you to move with us and to write these letters and make an impact. So thank you for that. Now let's get to questions. You have those different places for the chat. So go ahead and type in your questions and we'll get to questions. Adam did such a good job. Some really great metrics there. 1.5 units being constructed, 6.5 being needed. So Adam, go ahead and take it away. Thank you for your patience, everyone.
All right, I think we'll do some Q&A, and you can type in any questions you have, and I'll take my best shot at answering them.
All right, here we go. We have Bruce on YouTube. Is there a California exit tax when using a 1031 exchange? Oh, things moved on me. Let's see.
Yep.
Is there a California exit tax? While I look for this thing, it looks like it disappeared on me.
Yep, I understand.
Oh, there it is.
There we go. You know that the state animal, anybody remember what it is? It's on our flags, the bear. And there's something that bears have called claws, and there's something the state of California has called a clawback. And a clawback means that if you own a property in California, and you sell it and move out of state, and you do a 1031 exchange, there's no tax that's realized, and there's nothing payable at that point to the state or the federal government if you do a proper exchange. However, the state of California requires you to file each year so that when you eventually sell that property, let's say you move to Arizona, or you're in rental properties in Arizona, and after 3 or 4 years you sell it. You need to notify the state of California, reaffirm every year that you still own that Arizona property until you sell it. And then when you sell it, there's a calculation for the time that you had your investment property in the state of California. The portion of your gain, your taxable gain, would go to the state of California. In other states, it just goes to the state of residence and obviously to the federal government if you're paying your tax. But a few states, I believe Pennsylvania, certainly California, are very savvy about that, and they want to make sure that if you're paying the tax that was based on the gain while you were in California goes to the state of California. So not when you do the exchange, but if you ever sell and you ever owned property in California, you're required to pay a portion of the gain to State Franchise Tax Board.
All right, Jebster on YouTube. When interest rates double to 6%, many people will not be able to afford a doubling of carrying costs. Won't that drive prices down? And you did mention it.
Yeah, I'm 56 or 57 years old. That's a sign of age when you can't remember. I remember in the 1980s when interest rates were double digit, 13, 14, even 15% on a 30-year mortgage. And most of us remember that, or maybe even in the 70s, if you're old enough. What we often forget about, when there's a disparity in inflationary times between incomes, earnings, and costs. So, for example, when this gentleman's talking about what if rates double and they do go to 6% on average, that's a catastrophe. And all things being equal, yes, it would be very difficult, make it very expensive, to your point. However, generally there isn't, unless you're in Venezuela, this huge disparity between incomes and yields. In other words, when you go back to my 1980s example, and you remember you or your folks, depending on your age, had a 13% mortgage on your home, you were also earning 10, 11, 12% in a CD at the bank, right? I'm picturing everybody's heads nodding. Yields, dividends issued on stocks, bond yields, everything tends to rise with the tide. The problem is when yields and income are not rising fast enough to keep up with pricing. That's what happens with hyperinflation and disasters like Venezuela right now. I can't predict, first of all, when and if rates will go to 6%, but probably in the long term they will. Certainly with normal inflation they should. But again, everything else should rise as well. So those closing costs, you're going to have income or sale price, if we're talking about a real estate asset specifically, that reflects that appreciation. So keep that in mind. Inflation's not actually all bad. It's a natural part of our fundamental economy. We typically see at least a couple of points. That's why you bought a house for $20,000 in the 50s and $1 million today. It's the same house, and the value of those dollars is the same, but we've had inflation, so the number goes up. And the same is true of earnings and dividends and bond yields.
Great. And here's Kevin on YouTube. What effect does rent control and code enforcement have on the price of apartments, especially in highly regulated Los Angeles area?
Yeah, that's a great question. It's an irony. First of all, I got to stress, because most of our members, not all, but the majority are California residents. California is an unusual state in that respect, and certainly the city of Los Angeles, Santa Monica, and West Hollywood, and San Francisco have their own regulations, and that has a big impact on us, doesn't it, as far as our rent that we're able to collect and, more importantly, increase. But I want to make a couple of points. Number one, it is not common nationwide. There are very few other jurisdictions that have dramatic rent control, New York being another example that comes to mind. Generally, and certainly in the states where the DSTs I talked about were located, they don't have rent control. So it's really not an issue. They let the market take care of pricing. Also, and here's the irony that I mentioned, where is some of the most expensive real estate, not just in California, not just in the country, but in the world? When you look at the price per square foot, and it's in West Hollywood and Santa Monica and San Francisco. So the irony is, it's not depressing valuations, it's creating challenges, arguably very unfair challenges for landlords. But generally speaking, it doesn't decrease the value inherently, even though you might think it would. Just simply look at the listings in Santa Monica, and you'll see what I mean.
Right. Supply and demand still is still there.
Comes down to that. There's enough buyers, even with rent control, exactly.
Right. And then who ends up paying more is the tenant. So the tenant loses, unfortunately, so often. Here we are. YouTube, Robert, thank you for your question. Considering the drought, do you think the amount of building permits will be limited and or curtailed in Southern California?
You know, I'm going to refer you to the movie Chinatown, because that's the extent of my knowledge on water rights and expansion in building. In all sincerity, I'm really not qualified to answer the question. I do know that as there's growth in the inland empires, obviously not in Los Angeles proper or San Fernando Valley, you need to have adequate water, everything from toilets to your lawn. And the drought is a major challenge for that. I do also know, ironically, a lot of the water that we get here in Southern California does not come from Northern California. It comes from other states that are not drought-ridden. So it's actually Northern California that's more impacted directly on supply for water in those markets. But the answer to the question is I really don't know. I think if it became more severe, and certainly if the Colorado River and other jurisdictions areas have drought, it's going to impact us ultimately in Southern California. I don't think it's an overnight problem. I don't even think it's a next year problem, but it certainly in the long term could be a problem.
Great. On YouTube, John, thank you for your question. If you have taken cash out, refi some years ago and invested the cash, how does this affect the 1031 exchange?
Yeah, it's a great question. And it's interesting. I've been doing this a long time, and I've dealt with people far smarter and wealthier than me and more savvy, but a lot of people aren't aware of this, and it's because the tax laws are, of course, complicated. The answer is the IRS says when you sell your investment property, they're going to compare the price you sold at to essentially the price you bought originally and then depreciated, lowered that what they call basis or cost basis. So you bought it for $10,000, you sold it for $100,000. That's a $90,000 gain, and you maybe depreciated the $10,000 down to $1,000, so that $99,000 in my example is now taxable, is profit or gain. Now you notice I never mentioned what portion of that $99,000 was the loan on the property or the equity that you took out. And the answer is the IRS doesn't care. They know that you're able to refinance and pull that money out tax-free, and so therefore they want you to match with your next purchase $99,000 in my example. In other words, equal or greater value to the price that you sold at. And you have to reinvest any net cash proceeds after all the expenses and fees and commissions are paid. IRS says it's taxable if you touch any of that money. But if you reinvest it and you buy something of equal or greater value, you are able to continue deferring your tax. They don't count the fact that some of that money went back to the bank or that you pulled money out. I will say sometimes it's a good strategy if you own a good piece of real estate that has a lot of that equity I talked about earlier built into it. You do have the option to pull money out tax-free, refinance, so you are going to have debt on the property where you didn't before, but now you have a chunk of cash that you've refinanced that you could perhaps put to work, maybe invest in something that generates 4, 5, 6% cash flow, but the interest on the loan that you took out, the refi, was only 3%. That's sometimes a good strategy for investors, and that's something we discuss when you're contemplating a 1031 exchange. We help you with that decision making.
Thanks. That really was a good question. All right, Charles. He has a comment here. Your heirs will not be able to afford the 10 times increases in annual property taxes due to Prop 19. And we did. We told everybody we could, no on Prop 19, no on Prop 19. But that was a sneaky one that got through. What's your response to that one?
You know, it's going to, in fact, obviously what heirs are doing, and I suspect if that goes through and they're required to pay this huge increase in many cases in the property taxes, they're going to need to sell the property. The good news is, assuming there's no elimination of the step up in basis, which is a whole other seminar we can maybe do next time, there wouldn't be any real loss, if you will, to the heirs. There'd be loss in some of the profit, but bottom line, if they sell the property immediately, they would avoid the property tax and hopefully not have any inheritance tax and have a step up in basis. And so they're able to sell the property and take the proceeds out after your death.
Great. And George on YouTube, since the DST is a security, what will prevent Wall Street from creating another 2007 issue?
Interesting question. I haven't had it posed quite that way. What I would say is that a DST, while it is a security by definition of the Securities and Exchange Commission, it's real estate. In the final analysis, and I do spend a lot of time in trainings and as well as meetings with clients saying, you know, you already really know a lot about DSTs, even though I just told you about them. Why? Because they're designed to be fractional or co-ownership of real estate. It's as if you have deeded property. It's as if you have a loan and you're writing off the interest and the expenses of the property on your Schedule E. You know, you're getting your gross income and you report it to the IRS just like you do on your rental properties now. My point is, it isn't a stock or a fund or one of these collateralized instruments that they created in 2007. Those are other types of securities. This is actually very unique in that I would argue it's very much just real estate. It's simply packaged. There is a lot of review and due diligence, which I consider a positive, before it's sold to the investors out there. But it's a very different animal than some of the shenanigans we saw in 2007. And those weren't really based on real estate that had arguably real value or some value. They were actually based on the loans against those properties, those collateralized debt obligations. All those bad loans were turned into investment bonds and then were themselves levered with financing and multiple of the valuation. Long story short, if you do a DST, it's very much like buying a piece of real estate. There is risk, just as there's risk in any real estate, but the kind of risk that you're talking about with the securities world doesn't really exist in a DST. It's just not relevant.
Great. All right, here's Doris. Now's the time to utilize seller financing to reduce one-hit capital gains taxes.
I think, Doris, we're saying the same thing, and I don't disagree. There is an opportunity now to pull equity. Let's say you own property that's valued $1 million, Southern California real estate, maybe it's 8 units or what have you, or 6 units. Why not take advantage of these low interest rates, put a $500,000 loan on that property, probably get around a 3% interest rate. So you are going to have payments on the $500,000, but they're not too dramatic. Hopefully your rents have been keeping up with the market and you can cover it. Now you have $500,000 in cash that you do not have to pay tax on. So Doris, you're absolutely right. Just remember, as I said earlier, if you sell that property for $1 million, the IRS wants you to reinvest the $500,000 cash of equity that's there and either assume another loan of $500,000, or you could add cash and just buy a property all cash with $1 million. But they're not going to let you off the hook. It's just a way to basically turn some of your asset liquid and have access to the capital. And sometimes I think that makes sense for investors.
Great. And from Torrance here on YouTube, it is good to ask all housing providers to stand up, support AOA protest, and to end this thing on 9/30/2021.
I think that's more of a comment than a question, but I'll second that.
We've had a few comments on this thing.
Yeah.
But yes, thank you, Torrance. And it should be all of us. And whether we're feeling it or not, let's get it done, right? Let's just get those letters in the mail, and let's be the America that we are. Let's be free and exercise our rights to be free and to have a protest. And we don't need to throw a brick or do anything like that. We can do this with a pen and paper. And yeah, here we go. So Teresa on YouTube, how do you report a DST in your income tax returns yearly? Are there tax write-offs like Schedule E, or how does it treat it?
Great question, Teresa, and I'll go you one better. It's not like Schedule E, it is Schedule E. Right now, for each of your assets, you take your income, you take your expenses, you take your depreciation, and you report taxation on whatever net income that you've received. The same would be true of a DST. As I said earlier, I often say this, you already really know the answer, you just don't know that you know it. So if you were to own a 1% interest, let's say in a DST in Florida, 1% of the interest payment on the loan is deductible, right, against your income. 1% of the depreciation attributable to that property applied to your depreciation schedule is depreciable. 1% of the property management fees, the insurance, the taxes, all of those normal expenses and costs of owning investment real estate are deducted, just like it is now. So there actually really is no change. The way it's facilitated, because it is, of course, a $100 million asset, you will receive an annual tax report. You receive quarterly reporting on what's happening with the property. The sponsors I work with like to keep the investors apprised of how the investment's going. But annually you get a tax report. It's kind of like an income statement. And basically it'll break it out by your what they call pro rata share or percentage, so that you have each of those line items and you do put them literally on Schedule E just like you do now.
Great. That's really a good question.
Yeah.
For sure. All right. Tom Gu on YouTube. What is a typical DST returns?
Yeah, Tom, it's a good question. There's two types of returns. There's cash flow and depreciation. Again, we're getting into crystal ball time as far as what will happen. Sponsors are very good at figuring out what the reasonable net cash flow can be, certainly in the first year, because if it's a new property, they've already established all the costs and expenses and the income. If it's a little bit older property, you can look back to the last 12 months, trailing 12 months of income and expenses. So what I'm saying is in that first year, you're going to see a number. It varies property to property. Let's call it between 4.5% to 5.5% typically for the investment opportunities we tend to like. That's a net number of all those expensive, not factoring in depreciation, so that you're not going to be taxed on that entire amount. But about 4.5% to 5%, 5.5% on $1 million, $45,000 a year at paid monthly, distributed monthly. On appreciation, you have to look at the calendar to give you a good answer. A better answer is when I look at the sponsors that I work with, out of 40, by the way, or so, there's only about 6 or 7 that our firm works with by choice. We can work with all of them. but they're the ones that have the experience, that specialize in multifamily and self-storage. On average, they've seen, about 4 or 5% cash flow during their hold periods. I'm talking over the last 40 years, and about 4 or 5% appreciation per year upon sale in the future of the property. The goal of many of these sponsors is to have double-digit returns for the investor when they get to the point of selling. In other words, you've held the property 6 years, they've distributed X amount of dollars that's, let's say, equal to 5% of your investment. It's appreciated 25% or 30%, that's 5% a year over 5 or 6 years. That would get you to 10+% IRR, internal rate of return. And that's kind of their goal. That's the average, I can tell you. During the Great Recession, obviously, it was just holding on for some properties. I will say that the multifamily held on very well. They were just longer hold periods. The rents didn't rise as much as they had hoped, but they didn't drop a lot either. They just went flat. Vacancies went down, but not as dramatically as lower-end, older properties. Self-storage actually increased its average income nationwide. It's the only asset class in the country that did during the Great Recession, unfortunately, because of all the displaced people. But it makes it a very good recession-resistant investment. So, I would argue probably you can expect around 10%. If I were to give you the numbers from, let's say, properties that we worked with in 2015 and 16, well, this year we happen to be doing what we call rollovers. They're selling. It's actually a little bit faster than anticipated, 5-6 year holds, and the numbers are actually quite good. Why is that? Well, A, they're good properties that were managed well, and we did our job, and the sponsors did theirs. B, the market went our way. Obviously, rents have been growing at an exceptional rate. Prices, as we talked about earlier in the presentation, are dramatically higher. So we're seeing really fantastic returns, so good that I almost don't want to talk about it, and that's because I don't believe we'll see as dramatic an increase over the next 5 or 6 years, although I do think that they'll retain value and grow gradually like normal.
Great. All right. Jay Price, thank you for your question. If I sell and carry the mortgage, do I have to pay the recapture of the depreciation all in the year of sale? Are the Fed and state taxes only due annually for the capital of the mortgage paid to me?
The last part, for the capital of the mortgage paid to me, I'm not sure on, but I understood the first part, so let me answer that. And the answer is 100% of your gain will be taxable in the subsequent year, payable by April 15th, even if you get an extension. They're going to look at, again, your cost basis and then what's called your adjusted cost basis. They're going to look at your net sales price, your gross sales price, and then your net after expenses and so forth, and calculate what your capital gain was. If it were a stock, Apple stock, if it's held less than a year, it's treated as ordinary income. More than a year, it's long-term capital gain. Very easy calculation happens. Similar, but a little more complicated. But yes, you would owe all of it the subsequent year of the sale. That is correct.
Great. Here's Charles again. We're back to the beginning of the line. And Charles, what is to prevent a DST from never having a liquidation event since there is no contracted investment period?
Interesting. So DSTs, first of all, were created in 2004, and there were some strictures put around them by the IRS in order for them to be this great vehicle. They didn't make it easier for investors, as you would expect. One of them is that you're not allowed to refinance a Delaware statutory trust. You cannot refinance them like I was talking about refinancing your own property earlier. Most of the properties of any quality are so expensive that you need to lever them. You need to put not too much leverage. Let's call it 55% leverage, 45 to 50% down. A lot of equity, as I talked about earlier, again, into the property, but they will have a loan. Typically, for this type of institutional quality, high quality real estate, that's very common. Compared to the leverage in the early mid-2000s, they were north of 65, 75, 80% plus on these institutional type assets, part of the problem that we went through with the Great Recession. But as I talked about earlier, things have gotten far more conservative. So the answer to your question, Charles, is there is going to be a 10-year loan. That's pretty typical of a term period if there is financing on the DST. And at the end of that 10 years, you're going to need to repay the loan, which generally dictates the property will sell in year 7, 6, maybe 8, 9, 10 more likely. You generally don't want to wait till the last year because of the pressure. So it's dictated almost as a result of the loan as opposed to holding it in perpetuity if it were all cash, which is possible. But I stress that that's the whole property. In other words, you may want to sell your fractional share of the property earlier. And while there's no secondary market, I told you to think of it as an illiquid investment, you always have the right to do that from day one. Whether it's you need the capital back, you want to do a different exchange, unfortunately you pass away and you want the heirs to pull the money out. So there is the ability to exit. I do want to stress something since I brought it up, not directly to your question, and that is, what happens, Adam, if there's, I'm asking my question to myself, what happens if we're in a great recession and it's year 8, 9, and 10? You just said that we need to sell in that time period and you couldn't get a new loan. Wouldn't that eliminate the DST as a 1031 exchange vehicle? The answer is the sponsors that put these offerings together are very sharp, and they do think of these things. There is a mechanism in every DST to turn the DST, if need be, into an LLC. So it isn't a sale, it isn't a taxable event, it's simply a change of the character of the entity. If that happened, that entity would then go get a new loan if they had to hold past the 10 years. And then when the time came to sell, somewhere between the refi or the new loan and the sale, they would put it back up into the DST structure. So it's called a swap and drop is the term of art they use. So there is a way around it if you're bumping up against the 10 years and it's not a good time to sell and you want to hold longer in a DST. You just have to go through some of those mechanisms, which they already have in place and has been done successfully historically.
Great. All right. And let's see. Doris, is DST a form of crowdfunding?
Crowdfunding is a term that people use for typically online, small investors pooling their money. This has been around, I don't know, since the Magna Carta, I suspect. It's not a crowd-funded event. One of the things about crowdfunding is that each individual person is putting a very small amount in. We've seen that now with political campaigns. We've seen that with investing. We've seen that with charitable efforts. DST is very different from that. It's, first of all, not publicly available to just anybody online. Secondly, you have to be an accredited investor. These are meant for high net worth, generally real estate investors, so not just everybody throwing money in. And in a crowdfunding investment, usually you don't have that 100% pass-through of appreciation, expenses, cash flow. Pro rata ownership. It isn't the same as fractional ownership. Usually it's a partnership interest. Maybe you get 80% of the profit upon sale, for example. Maybe you get only 10 or 90% split of the expenses that are deductible and the manager keeps it. Very different ownership structure. Really, it's just an online version of what we used to call a syndication, where a company would just pool $50,000, $100,000, $20,000 investments from numerous people and then go buy something large and manage it. That's very different than a DST interest.
Great. And then a question for Sarah. Is real estate still the best investment to put your money in?
One word, definitely the best. That's why, the DST is real estate. So that's definitely where you're going to want to keep your money. You're not going to want to, well, everybody's different, and that's why we like to have conversations prior, but to just sell and cash out and pay the taxes might not be the best way to go. It might be to keep buying real estate, keep buying another portion of real estate, just stay in the real estate industry, but your role in it is going to change, but you still hold real estate, and that's just the best thing to do. Great.
Thanks, Sarah. And it looks like our last question here, unless someone else puts a question in before we finish answering this one. Jay Price, thank you. Can the title to a DST be held in the name of a trust, or must it be as individual names?
Yeah, excellent question. So as I said earlier, you actually already know the answer to the question. You just don't know that you know. When you do any kind of 1031 exchange, whether you're buying your own investment property alone or whether you're investing in a DST, you want to keep the entity or the vesting the same. Meaning if you own your, let's say, apartment building in a family trust, when you purchase your replacement property or DST, it needs to be in the name of that trust. You don't want to change vesting. Some tax advisors will tell you to wait 2 years. That's not a statutory requirement, it's a best practice. But it is important because the IRS doesn't want one taxable entity doing an exchange and passing the benefit on to another taxable entity, for example. So you want to have it consistent. When you go into a DST, as I said, just like any other real estate, if you owned it in your family trust, the property you sold, you'll take title to your DST interest in that same family trust. Now, after you've closed on your DST interest, you've done an exchange, you certainly can change it. What we do see a lot of investors doing is owning property in their own name as an individual. You have to keep it, or you should keep it in that same vesting, but then later, because you put together a family trust or a revocable trust, you want to change your vesting characterization in the DST or in the new property you bought after you've closed. And that's often advisable. Some people wait the 2 years, many people don't. And that's something you'd talk with us about, and more importantly, your tax advisor. But vestings, again, you want to be consistent in an exchange, and frankly, you probably shouldn't be changing them either on the down leg on the property you sold or the up leg, the property or DST you purchase, anywhere around the sale. That's a red flag for the IRS.
All right, Howard, he slipped a question in here.
Sure.
Thank you for your question.
Yeah, I didn't want IRS to be the last thing I said. So.
What are some of the changes coming with tax law that is still related?
Just a little question. Two things, Howard. If you go to, if you Google on YouTube, Apartment Owners Association or AOA Adam Bryan, I think my name's there. There it is. I actually just did a very similar webinar with Sarah and Jeff on this very topic. I won't hazard to do another seminar with our last question, but I will tell you, keep in mind nothing has happened yet. There's a lot of talk and a lot of speculation. What I can tell you is that it takes time. Typically these things get watered down. I could go on about the proposals, and I have talked a little bit about that. But the reality is, until there is a bill that's put together, it's voted on by Congress, whether it's passed through reconciliation or the majority of 60 through the Senate, and then it's put on President Biden's desk, nothing means anything. We just don't know. And there's a lot of speculation, everything from eliminating 1031 and the cost basis to increasing taxes for the higher income folks. And that's the one thing I'll leave you with. If your income is over $400,000, your ordinary income or income in conjunction with your adjusted gross capital gains, you're probably going to see some tax increases in the next year or two or three, almost undoubtedly. I'm willing to put some money on that bet. But that being said, there's a lot that's speculated that probably isn't going to happen. And also, there aren't really that many people, even very wealthy individuals, families, that have an income, an adjusted gross income that high. So it's going to happen probably, in my humble opinion, but it's not going to happen to nearly as many people as I think folks think, and it's probably not going to be as bad as many people think.
Right, so check that video out. And also, just literally last week, Carla Dennis, she is a tax expert. She has a master's in it. She's been doing it for years. And she goes through kind of detailed some of the proposals that are out there within that infrastructure package. Mm-hmm. And so that one, you can take a look at that. It was very interesting to hear her share. She's great. So take a look at that one as well. And then Veronica, so we don't end on taxes.
Okay. Yeah, right.
Thank you, Veronica. Here we go. If I am an heir now in an irrevocable living trust and I get the property transferred over to me within the next year or less, will I maintain the same level of value in property taxes once I am the owner?
You know what, Veronica, that's really, I'm going to defer to an estate attorney. I have a great one I can refer you to. Call me at the number you see below. Because you said it was an irrevocable trust, and that's probably what's prompting your question, that does change things from kind of my standard answer. So rather than speculate, I'm going to say really it's not a question for me. I'm more knowledgeable about real estate in general, 1031 exchange, and obviously the DST interest, and I don't want to steer you one way or the other incorrectly.
Great. And just any last comments, parting words that you would like to leave with us, Adam?
Thank you so much. Well, first of all, Jeff, thank you, and thank you, Sarah, and Dan, and all the folks here at AOA. We've had a 20-plus year relationship. It's been very positive, and we appreciate the opportunity to speak to your members like this. I do feel pretty confident, and I'd like to leave folks with that thought. A lot of fear out there, a lot of uncertainty. We just went through this ridiculously unprecedented pandemic, but kind of apropos to what Sarah said, I remind you that real estate values increased 8 to 10% on average last year during this crazy economy. I'd be cautious of the public stock markets, the equity markets, because they are very frothy and arguably overvalued. Real estate values, as you heard me talk about at the beginning, while they are high, and it is feel a little bit like 2007, the fundamentals are just not the same. And I do feel very, very strongly about keeping your money in real estate. And if you're doing a 1031 exchange and you don't want to manage the property and deal with the day-to-day headaches, consider the DST, and we'll talk about it and see if it's right for you and your family.
Great. Thank you so much, Adam. And everyone, remember, if you like this kind of content, go ahead, subscribe. This is not monetized. We're not making any money by you subscribing. It's just a benefit for you. So when we put something out there, then you're notified. If you hit the notification bell, you'll get the notification. It's just to keep you in the know. And also, you can register for these events. We'll have an event next week, and then the week after that, it's the Americans with Disabilities Act. We're going to be covering that with an expert, and they'll tell you how to stay out of trouble and think really well of how to accommodate everyone that's renting from you. And so that'll be really good. And then again, Dennis Block will be the week after that. Richard Beckman the week after that. Those are both attorneys that will just give you legal updates. And that's great live Q&A time, as well as a presentation from them. And anyway, if you are not a member with AOA, go ahead and join. And we'd love to have you jump on board. And don't forget to get those letters out there, so that to the governor and to your city, the mayor of your city and the city council members. And anyway, thanks again. So many of you have done it already. We have such an amazing tribe here at AOA. All of you, thank you. And we'll see you next week.